Hello and welcome to our ongoing series Outlook 2024. Today it's the bond and rupee markets. The Indian rupee rose and bond yields fell by about 5 basis points this week itself after Bloomberg Index Services announced that it is including Indian bonds in its EM local currency index from September. But the rupee and bond markets have far more fish to fry. What will be the Fed's rate cut trajectory? Will Reserve Bank move in step? Will it move ahead of the Fed? How much will the fiscal deficit be in the vote on account that is going to be announced on Feb 1st? Will it fall from 5.9 to 5.4? In that case, how much will the government borrowing fall? In short, can we see a bond rally, a bond and rupee rally this year? That's the big question to ask B Prasanna, the head Global Markets Group of ICICI Bank, who's joining us. Prasanna, best in the business, is joining us. Thank you very much indeed. Well, first up, we have to parse the global environment. What's the sense? 3 cuts is what the FOMC dot chart said, but the CME FedWatch tool is saying 6 cuts. What are you going with?
So I think, yes, Latha, I think you got it right. There has been a difference between what the Fed is telling us and what the market is discounting. I would say that the Fed kind of caught up with market expectations when they did the pivot. A little bit they went ahead of the market, but the market has now gone further ahead of the Fed. So the market, if you actually really look at it, over a 2-year period, the amount of rate cut expectations which are there in the market and the kind of rate cuts that the Fed is saying is broadly similar, give or take, maybe 10 to 20 basis points. I think where the real difference is lying between what the market is expecting and what the Fed is saying is how much of rate cuts is there in the first year of the rate cutting cycle, which is the current calendar year. While Fed is saying it's around 75 basis points, the market is going with around 140 basis points. So that's where the real difference is. Where we stand in this, we actually feel that the market has got ahead of itself, and we are kind of penciling in 100 basis points of rate cut, maybe at best 125, definitely not the 140 or 150 basis points that some market participants are expecting. But market being market, I think what they are effectively doing is kind of pricing in an option value. Because typically when a rate cut cycle starts, the Fed is never going to admit beforehand exactly how much quantum that you're going to cut. So they will be cautionary in their initial steps. We can call it as baby steps or whatever. But as you go along and as data comes in your favor, if data comes in your favor, which is what it looks like right now with inflation, incremental annualized inflation for the last 6 months slowing down almost close to the 2% range, it's quite possible that the Fed at the end of the year would have ended up cutting much more than what they are telling you at this point of time. So I think that exactly is what is getting priced into the market right now.
Now, see, for you, the more important thing will be what is the 10-year yield at and what is the dollar index at. So if you have to give us a range at the moment for at least the first 6 months, do you think it still hovers around 4, the 10-year yield in the US and dollar index 102?
Yeah. So when you look at the bond yields, Latha, in the US, you need to look at the 2-year and the 10-year a little bit differently. The 2-year is probably or broadly going to be determined by what is your expectations of what the Fed is going to do. And that's at around 430 or so, which is building in the kind of rate cuts that we were talking about. But when you look at the 10-year, you have to have a view on the Fed as well as what the fiscal supply of the government treasury is going to be and what kind of demand is going to come from international investors as well as domestic investors in the US. So my predilection right now, or my dilemma right now, is that we really think that US 10-year is almost kind of priced to perfection at 4.05. And there is an upside risk to the bond yields in the longer end of the curve, primarily because of the fact that there could be the fiscal fear which was there amongst the minds of international investors just before the Fed pivot happened, that could come back because that's been forgotten. And they are going to borrow quite a bit starting very soon. So that could come back. So that is a dampener for the long bond deals. The 2-year is going to pretty much react to how data flows in and how the Fed is going to admit to what kind of rate cuts. So even in the 2-year, I really feel that there is an upside risk because we really don't believe that the Fed is going to cut in March or even May. I would go with a June rate cut, in which case, if there is a delay in the rate cutting cycle, the 2-year yield also will tend to go up. Either which way, I think the yield curve in the US will need to, become positive. I mean, it has been negative for so much longer. It has to become positive with the 2-year yield being lower than the 10-year yield. And I think that will happen by way of a bit of both, with the 10-year yield going up and in due time, the 2-year yield also coming down as they react to, Fed updating its inflation projection and updating its rate outlook. And on the dollar index, I think we have seen dollar index moving from 107 to 102, back to 107, then again back to 102.
102.
Typically, dollar, currently we are at 102. Dollar gets a lot of benefit from the high carry that it has been getting by virtue of the high rate of interest that is there in dollar bonds. What we really feel is that typically in a rate cutting cycle, the dollar weakens, which is what the entire world is now talking about, the fact that this year is going to be a year where dollar weakens. The only one cautionary thing that I would say is, while we also believe that the dollar will weaken as US yields keep going down as we go forward, the extent to which it can weaken is, I'm not very sure it will be a very deep weakening. And that is primarily because of the fact that the differential growth between US and the rest of the globe is actually still in favor of the US. US is, though slowing down, it's slowing down less than the slowdown which is happening in the euro and the other areas. So to that extent, we do feel dollar is headed towards, dollar index is headed towards 99 to 100 kind of levels during 2024.
Okay.
But we'll have to keep a close watch on all the things that I spoke about.
Well, I was going to ask you if there will be a bond rally in India, but since you've spoken so much about the dollar, is there a rupee rally? Considering that we're going to get money from the inclusion in the JPM index, as well the Bloomberg Index, although that's much, that's just about 2 billion.
So on the rupee, Latha, I think you also very well know, I think it all depends on what the RBI thinks. So we have seen periods of depreciation and periods of appreciation in dollar in the global markets, and that has remained untouched in the rupee market, primarily because RBI has managed volatility on both sides. So there are two parts to the answer. The first is what's happening on the fundamental side for INR, and hence what do you expect the markets will do? And the second is, what do you think RBI will do? So as far as the fundamental aspect is concerned, I think it's been a great, it's going to be a great year for India at this point of time. We do have expectations of current account deficit being much less than even 1.5% of GDP, close to around 40 to $50 billion, which will lead to a BOP overall surplus of close to $35 billion this year, as well as in next year. And of course, you very well know that I think the primary driver being remittances and the export, software exports, which is really cushioned the oil blow a lot. So from that perspective, and if you add the fact that there is a bond index inclusion giving around $20-25 billion, maybe more if you take active fund managers, and there is, equity inflows also expected to come on account of an impending stability that the market is, political stability that the market is pricing in. It looks like the year is going to see a lot of capital flows. So from that perspective, it will be a positive year for rupee. Now, will the RBI let it appreciate becomes the second question. I would assume that maybe another $10 to $15 billion RBI will still continue to intervene and prevent the rupee from appreciating as dollar flows keep coming in. But beyond that, I think RBI might not have any option but to let it appreciate. So I would possibly go with the call of a rupee moving towards 82 during 2024. Maybe not before March, but after March.
Okay. Well, even as you speak, there are statements coming in from vibrant Gujarat of huge investments. FDI has been a non-starter in 2023. The story could be different in 24, and that'll also be another piece. Now, a big question, will there be a bond rally? What are you factoring in terms of fiscal deficit? Will the borrowing be much less than the 11.8 lakh crore that the government is borrowing in FY24? What's the borrowing you're going with? And will there be a rally simply because rate hikes are off and there is this index inclusion?
Yeah, so again, Latha, you are right that things are favorable for a bond market rally if you take the calendar year 2024. However, you might want to possibly split it into two parts: what's going to happen before March 24 and what's going to happen beyond that. In terms of our fiscal expectations, we are going with a 5.4% fiscal deficit expectations for next year, which is a 50 basis point cut. But having said that, I think the total SLR supply is going to be very similar to last year, maybe marginally lower. But in terms of demand, I think I really do feel that the insurance companies and the provident funds, which have been long-term investors in this market, are going to pick up quite a bit of slack. And at this point of time, I don't think with the bond index inclusion also coming in, even if it is half of that is going to be matched with RBI doing OMO sales to absorb the liquidity, I would assume that the supply is not very daunting next year. So from that perspective, things are in favor, and you of course have a rate cut expectation sometime during the year. So if you have to assume that the Fed starts cutting sometime in June or July, and also assume RBI cuts from the second quarter, then I think there can be a bond rally which will happen towards the second half of the current calendar year.
Okay, that's a photo finish. Thank you very much, Prasanna. Bond and rupee rally likely.